Wonderful. Great. Thank you very much, Sean. Thank you very much, everyone. I really appreciate you spending the, your afternoon, your evening, right before Christmas Eve with us. I hope you've had a wonderful season so far, and hopefully it will be a wonderful holidays and even better and more blessed 2021. 2020 was a mixed blessings in some ways. A lot of things happened, but I'm just so grateful to again have you part of our community. So what I thought tonight, for our class, I thought it would be timely if we speak about the markets and the valuation of the markets. As you know, every Saturday when we do the market analysis, I like to approach the markets from 3 points of view. One is from the fundamental side, and we mix the economy with that. The second is the sentiment side. It's about the psychology of the buyers and the sellers and what the market thinks from the behavior finance and psychology side of things. And the third part is the technical analysis that we look at again the chart, which mixes the psychology with it, but also we look at the historical point of view and see where we stand compared to the past. So uh, we've had a very obviously unusual year, and it's been beyond anybody's imagination. So uh, tonight, I thought I'd like to approach the valuation from fundamental point of view and see where do we stand. Is this, are we in a bubble? I mean, with all kinds of valuation that we will look at, it's kind of hard to comprehend that we are up for the year and we compared to last year, which nobody would have thought we will have really depression in some segments of economy, and here we are, all-time high in every single index. So let's see where do we stand, and as far as what is our outlook for the future, and do these valuations, these fundamental numbers, do they actually make sense, and should we put a lot of value on them? I shared this a few weeks ago with you, and I'd like to share it again based on this was done exactly a year ago on December 23rd. Basically, some of the top brokerage firms, they come up with their prediction, which is, it's a nice gesture. It's a good conversation piece at the parties, and they come and they say what their outlook is, and it usually varies. Sometimes there's a big variance, but you can see that like the most optimistic person last year was Piper Jaffray, and Jaffray is like they predicted the S&P would be at 3,600, and we passed 3,700. Granted, we just sold off toward the end, but we've been as high as 3,720 or so. And then the most negative was the 3,000. So the prediction was the market will go up either 11.4% from that day on, or it will be actually down 7%. So the median number was actually 3,333. The question I have is, with this valuation, this was no COVID factor. There was election factor. There was a almost full employment. We were looking at one of the lowest in the history, really. And here was the valuation. Now, the question we have is, with this unbelievable event that nobody really predicted and the effects it had in the economy, how can we be at almost 3,700 today? What are the reasons for that? And what are the valuations that we can use to see use as a barometer to see where we stand? And we will analyze again why we are here and how did we get here. This is actually today, 1 p.m. West Coast time or Pacific time. Robert Shiller looks at the inflation adjusted S&P 500. So I thought went back to 1870, and we wanted to see, compared to where we've been in last 150 years, where do we stand now? And again, this is inflation adjusted, so it's not absolute number. And as you know, we could started at 100 in 1870, and we are at 3690. So some of the large turning points, as you can see, there was like the October of 1929, the Black Tuesday, and then obviously we had 1987, Black Monday. So we're looking at historically, today we're at 3690. The mean has been about 574, and the median has been 267. So the lowest we've ever been was 70.41. Again, this is inflation adjusted in 1877. And today, actually, this is, again, adjusting for the monthly. So it's looking at the 3690, 3668. So we are actually the highest we've been. Doug Cass does the S&P value. This is the as of end of November, and he looked at, again, from the fundamental point of view, which we're looking at the enterprise value to sales. We look at the market cap to GDP. It goes from price to sales, price to book value, and on and on. Adjusted PE, which the cyclically adjusted, which is the CAPE. So almost every barometer tells us we're on the highest we've been. We are in a red zone as far as, again, the valuation, and the 100%, which is the highest. So let's dig a little deeper and look at what, in this case, Robert Shiller is looking at. And again, we go back to 1870 and then come to today, and we look at the price earning ratio, which Shiller uses differently. It looks like the 10 years inflation adjusted. And what we look at, and as you know, I'm pretty contrarian, so I like the anomalies, but I also look at we use this terminology, the rubber bands, and I like to look at the extremes and see where we stand as far as the past and the history, because I think history does repeat itself. And what has happened in this situation, as you can see, on Black Tuesday, actually, the Shiller PE standing at 30. And on Black Monday, we were about 17.5, about 18. And the highest that you can see is basically was December of 1999, right before the Y2K and then obviously internet bubble. We were at 44.19. And the lowest has been 4.75, which was at the turn of the decade, right after World War I. It was right after the century's pandemic, last century's, the 1918, the Spanish influenza. So right after that, you could see the markets were pretty depressed. So I hear some on this, a lot of actually people that I respect, they feel the 1920s is going to be like a roaring 20s of 1900. So the 20s are going to be, the 2020s are going to be like 1920s. And this is going to, because of, again, the technology, because of all the advancements that we've had. And obviously we do have the really friendly central banks around the world. So, but again, when we look at it in 1920, the PE ratio is at 4.78 compared to 33.59. Now, the reason I want to share this, why the valuation is important, and that's why I'm going through these, is it's nice to be young. I mean, this year, we found a lot of new traders, Robinhood traders, and I look at it as a child who's fearless. It could be a lion sitting in front of them or her, and they can go and pat the lion, and sometimes nothing happens. On the other hand, us as adults, and especially parents, because what we have seen, or based on our experience, what we've read, our brain is telling us that the amygdala telling us, oh, there should be a fear. We are very much cautious and obviously very worried. We don't want to go even, 100 feet of a lion. So basically, I see the markets the same way. As older I get, I look at things and I look at historically, and I look back. I mean, 1990s is very vividly clear in front of me, and I remember, people who, let's say, bought in the 2000. It took them 15 years. Let's say somebody invested money in 2000. It took them 15 years to break even. For someone from 1966, it took till 1982 to break even. So the markets, granted, they do have the momentum. They go, they've been on average, they've been up. But believe it or not, for the last 20 years, the market has been up from 2000, has been up average. It's been averaging about 4%, which is ahead of the fixed income. It has been ahead of inflation, which was 1.5%. But when you look at these numbers, you think, oh my God, it should have been a lot higher. So basically, when the bubbles happen, they really take everything down with them very hard. And it takes a long time to come back up, as again, the history tells us. Some of our foreign or international markets, and Japan is a great example, it still hasn't gotten back to where it should be. And, we look at the markets from 2006 in Europe, some of the markets are still not back where they were. So that's why I think it's important. The valuation is important. What happens, the bubbles don't burst, they don't happen immediately. It will continue. But when it does, there's no stoppage, and it's very painful. So this is not a warning right now in the sense that, oh my God, there is a bubble coming next week or next month. It's just what I had seen. I remember in 1999, for instance, I was very cautious, and I was still in the value stocks at that time, but I missed like an 85% run in 1999 for, like, say, NASDAQ. And then, March of 2000 comes and happens, and, the rest is history. So we had Y2K then. Is this COVID similar to that? Is the valuation similar to that? So I like to continue with our next valuation. And we look at the price to book value right now. And as you can see, we are the highest we've been since 2000. We are at 4.09. And basically, when we look at the mean has been 284 and the median has been 2.78. So March of 2009, you could see that was a turning point, and that was the lowest. So there was a good value to get into the markets from the price to book value, especially a lot of financials, they had gotten really undervalued tremendously. And of course, it was a financial catastrophe at that time, financial crisis. This time is a health crisis. But the highest was March of 2000 at 5.06. We had 4.09. Also, we want to look at the revenues, the S&P 500 price to sales ratio, again from the 2000. You see in 2001, actually, we were at 1.8. We were at 2.69. So but you can see the lowest was again at 0.80, which is, anything under 1 is very attractive. And we were at 0.80 in March 2009. The median is 1.5, but we are at 2.45. So from every aspect of valuation, you can see we are pretty stretched. When we look at, this is by Rosenberg research, when we look at the price to the operating earning ratio, that's what I like to see things from the earnings are more realistic, is you can see again, we are back to where we were in the early 2000 and what we were in the 2008 top. And we have gone actually above and beyond that. So again, from the price earning to the operation, we are pretty stretched. When we look at the earning per share, which is important to see what, again, I like to emphasize operating earnings. So you can see in 2009, we were really undervalued, and we were beaten up because expectations are very low, and we had a really nice bounce back. And this happened in 2009. In March of 2020, again, we got really, again, operating. There was a lot of fear, and the earnings, obviously, the economy got affected tremendously. The question I have is the markets are way ahead of where we were in 2018 and 2019. Yet the operating earnings, which is that's the valuation comes, we're still behind where we were in 2018. So what justifies this valuation? What is the reason that we are where we are? And when I talk about markets, I'm not just talking about United States. So this is research done that basically we're looking at the globally what is happening with the other economies. Now the median, as far as the most accepted, the PE ratio, the average that as far as the valuation they accepted is a P of 15. So when you use a P of 15 for global valuation of the MSCI, is the Morgan Stanley Composite Index. This is where we are supposed to be, and this is where we are as far as the markets where they are now globally. And when we look at, again, the valuation, if 15 is the average and where the market it should be, this is how stretched we are. This is where it was March. We were undervalued then. In December of 2018, we did that globally. But this is how where we are since 2006. So even globally, we are sitting at 20.8 compared to average of 15. Although there are some places which are attractive. I've mentioned about the dollar and why I think, let's say, emerging and developing markets will outperform us, especially with the weakening dollars. That's another story. But generally, what we look at is when we look at USA, the optimism is a lot higher. But when I look at some of the some European countries, I look at like Canada, even Switzerland, there's optimism is not as much, so they are more undervalued compared to United States. Continuing now with the forward PE ratio, and this is important because it's PEs are past, usually trailing 12 months. We look at that. What the analyst thinks about the forward PE for the next 12 months. And as you can see for 2021, they're pretty optimistic, and they're looking at this moment, they're looking at for the next 12 months at 25.95. Again, we have to go back to 1999 to see what was their projection for the forward PE. And as you know what happened after. Now, I thought to share this. This is what they're thinking for the year end of 2021. The average earning per share, they're projecting that the earning per share for S&P will be $170, and basically the PE ratio will be about 23.74. So with that valuation, they're looking at the market's S&P will finish at 4,035. But the most optimistic is about 4,400, and the lowest is 3,800, which is still ahead of what we are now. They're 100 points more, and that's the lowest. These are the sample of some of the analysts at Bloomberg contacted and looked at their analysis. So I thought to share that with you. Again, as you can see, the average looking at about 4,035. The question is, are the analysts optimistic? And the answer is yes. Basically, this is, I believe, Yardeni did this research, and we looked at what the analysts had projected since 1995, which is the blue lines, and what was actually happening, which was this purplish line. And as you can see, everything they were projecting, the actuality has always been lower than what the prediction was. So historically, this is, the IBES data, which is an institutional broker estimated system. So that's the totality of the data they gathered for all the company's earnings. And this is where they come up with the actual numbers. And what you can see, again, analysts just naturally, they're optimists because they work for the firms that bull market makes the money for them. Bears they're not profitable. So majority of, again, the firms, they want to be positive and they want to be bullish and they want to keep their relationships with the corporate management. So that's what you see. There's always this bias. And basically what we look at, again, the over optimism. Now, this is from Steve Blumenthal from the Ned Davis research. And when we look at where we're standing now from the median price and earning ratio, again, from a different point of view, what we could see, this is where we are. And as far as the ratio, we are, again, one of the highest since the 2000s and 1999. So when you're in this area, we are very much overvalued and we are above the 30. And obviously when we are under 20, about 17.3 is the median. That's where the attractiveness is. So according to Ned Davis research, this is as of end of November, the idea is if we have to drop 26% just to get close to the top of the median, which takes the S&P to about 2,700, which is about 1,000 points below where we are now. If we go to actual fair value, which is at 17.3, we have to drop to 2,035. And that's where the best place will be to actually, will be very attractive to be a kind of a long-term holder and being an investor in the, buying indexes. And obviously they're very much really undervalued. That's the lowest where the real bargains are. We have to go to 1,400. So with that, they did another study. They looked at when we are in the lower or the top quartile as far as the valuation, the PE ratios, the median, and then when we are in the lowest, which is the most attractive. So it's this one, the green, and then we look at the red is when it's like really expensive. And that's where we are right now with this median. So what they looked at, they say, if we are in the top quartile that we had been, let's say in 2000, that's where we were. And we were in 2008 and 2020, we have actually surpassed the 2000. And then we compare it again to 1929. Every time we are up there, what happens in 1 year, in 3 years, in 5 years, in 7 years, in 9 years, in 11 years. And as you can see, for the next 11 years, we're still going to be in red according to the performances. And when we are in a valuation, is a low valuation, you can expect a decade to make 241%. So what this tells us, again, this is from the Ned Davis research, is that where we stand right now, if you are a buy and hold, and let's say you bought indexes today, they foresee that after 10 years when you come, or 11 years when you come back, you're still going to be flat. So I have talked about, again, in my opinion, the decade of 20s are going to be difficult. I know a lot of other people disagree. I'm not in business prediction. I learned my lesson early on that, we are not in the business predicting the markets. We are here to find opportunities. And I think money management is the most important thing. Decade of 2010 to 2019, that decade of the tens was wonderful for momentum because we came from a decade of really basically nothingness, in the sense that the 2000 to 2009, there was no growth and there was no actually the stock market. So we go these peaks and troughs. So basically I feel that this is going to be a probably single digit, if that, not even higher single digits. And that's why I promote the self-education. This is a time to really be, in my opinion, it's a good time to be an active investor rather than passive investor, which goes against, majority of the investment advisors, because they want to have the money under management and put them in index funds, and which is fine. But I think we have little challenges. Now, what is going to happen? Is something going to happen tomorrow, a month from now? Or And again, I learned my lessons from 1999. In 2007, I actually shorted the market and I got out of my positions. I had to wait till 2008. So thankfully in 2008, I didn't lose any money. My clients actually were up for the year. And the reason was I had to be patient. 1999, I had to be patient. And basically, bubbles don't get burst immediately. It could take like 1998, 1999. It took 2 years, a year and a half. In the meantime, they can continue the momentum. So as long as there's that momentum and there's liquidity, they could continue. I want to just share with you, this is more of a history lesson, but also make you, again, be more independent thinkers. There's nothing wrong with having a little hedge, like insurance on your portfolios, what you have, and just be cautious. Again, nothing probably will happen a month from now or 6 months from now, but I like to be proactive in managing my investments. So with all these valuations, so why are we here? Don't we have COVID? We had an election. We have uncertainty about the second wave of COVID. The economic impact we haven't seen it yet. Basically, we don't really know with the small business, the waves, what's going to happen. Yet we are in all-time highs. So before I go through that, let me explain another segment, which is the effect of the FANGs, the Facebooks and Amazons, and basic should be Apple part of that, and Netflix, and we look at the Googles of the world. I would include them in Microsoft, and as of Friday's end of Friday was Tesla. Just look at the performance of the FANG since 2012 compared to S&P, and that could give you a little bit of an answer. One of the reasons why the markets have been so high. And also, when we look at the forward earnings and revenues, you see that from the capitalization point of view, these FANGs, they represent 12.4% of the whole S&P 500. And while their revenue is only 0.6, the capitalization is 12.4. And that's what is helping. And we've talked about this in the past. It helps to explain why we've had this, again, the momentum in the markets, and we've had this ride, especially in the technology. So the answer would lie in the Fed. Why we are here, why, at this moment, we cannot compare it to like 1930s depression. At that time, we didn't have an active Fed. The central banks were really caught off guard, and the banking system was in debacle. So it seems like the Fed plays a lot more role especially in our markets, than the monetary policy, than fiscal policy. The reason I say that, the fiscal policy, we had the unemployments, we had the PPP loans, we had the stimulus checks. They all dried up in July, basically during the summer. They all come and gone, and basically the markets kept going up. So that means that the monetary policy is very important. Now, this is from the St. Louis Fed, the Fed numbers, and you can see where we were in as far as 2003. We were under, now 1 million, put another 6 zeros in front of it. So basically it's 1 trillion. So we were under $1 trillion. That was the Fed's balance sheet that you hear, all the assets, the things that they have been buying and they've been holding. So their balance sheet, the assets, was under 1 trillion. Now, if you recall, in 2018, they started actually reducing the balance sheet, and they were trying to do like in something, lighten up on the balance sheet. And that's when, if you recall, 2018, December, newly elected Chairman Powell came and they said they're going to actually increase the rates, and the market really reacted. But we were successful in reducing balance it. And then this 2020 happened, and look at this is parabolic move. I mean, this is unbelievable how much we just went from a little over 4 trillion to almost 7.3 trillion dollars at no time. So one of, again, probably the main reason that we have this markets right now, we have very accommodating central bank. Now, this central bank is not just in our country, not in the United States alone. I just want to share this with you from Thomson Reuters, is you can see how much of the balance sheet growth the Bank of Japan has had this year, for instance. They've been actually increasing, but, and we look at the ECB, the European community, we obviously we look at our own, the Fed, Bank of England, and then the Swiss National Bank. So it's not us. Every single bank has been increasing their balance sheet. So that kind of explains why we have such a, well, you can say overvalued in a absolute base market, because the rates have been so low because of the policies of the central banks. So we are in under 1% in the 10-year note. Fed chairman, the last meeting that they had, they came out, they are not in the mood to increase that. And what will happen is basically once they I think they, at least 2 years, they're not going to touch this. So you're looking at a low interest rate unless the markets and inflationary pressure comes in and forces them to do something like that. But for now, the active Fed is on the side of a low interest rate. And I think this is what's going to help you to understand why we are where we are. The reason we are here from the earning yield, and what earning yield is basically the earnings divided price. It's almost like a dividend yield. What amount of the income, the net income we have based on that price. So we are at 2.69, which is for every dollar you get 2.69% on our, based on the net income. So this looks probably, as you can see, it's one of the lowest. We go back to 1918. You see we were at almost 19. We go back to 1980s, we were at 14. And those were the times that it was a great yield. And basically that's when the bull market gradually started, and we've been on the bull market. But now we are, so the markets really have to look at this and say, my God, we are not getting a buck or a bang for our buck, for instance. And the next, you can see that the average yield, earning yield, the mean has been 7.32, the median has been 6.74, and the best was December of actually 1917 was 18.82. So why it's seeing this with such a low yield, we are in such expensive markets, and why people are buying the stocks? And obviously the answer is the alternative. There is no alternative, because we pay the premium for the equities based on, again, risk-free rate. We want to see what is the alternative based on that. And when you have the yields near zero for the Fed, when you have anything under 1%, there is no competition. So we are willing to pay higher premium in order to own the equities, because granted, if it's 2.69, when I go back, for instance, in this situation, when we were in 1980s, some of you remember the interest rates were up 14, 15%. So that was the net difference was actually negative. So in reality, markets look for the best opportunities and they look at the best yields. And at this moment, with accommodating central banks and accommodating all the central banks with the low interest environment, especially again, the activities on the borrowing side, which has helped the corporations, it has helped the homeowners, and kind of created some activity from that. And that creates, again, the liquidity and also creates the opportunity. So with that in mind, I just wanted to, again, explain why these the valuation is there, and purely, I believe, is the monetary. Because when I look, um, the market has really taken into account the best scenario at this time. They think the vaccination is going to save everything. They are looking at, this stimulus package is going to be everything that they wanted to, even though it's not. We are looking at Brexit, for instance, and we are not even talking about the tariffs. We're not talking about the trade. We're not even talking about geopolitical. So I go back from our, the our first slide I was speaking of. Basically, in December of exactly a year ago, the economy was rolling. We didn't have any challenges in that sense. There was the China trade people were talking about, and the election. And since then, I mean, right now we have uncertainty about the taxes, tax rates, what's going to happen. So there's a lot of uncertainty, but the market doesn't look at it that way. And that's what makes me concerned. So the market is looking right now just on a pure, in my opinion, pure yield. But the valuation eventually comes into the picture. It might not happen a month from now or 2 months, but eventually when it happens, it's not pretty, because a lot of people have gotten, especially this year, about, the trades have been very attractive. They're making money. But again, I go back to year 2000. When it hits you, or go back to 2008, 2009, it takes a long time to come back. So, but the bubbles just don't burst with, let's say, increase of interest rates. Interest rate alone, even if Chairman Powell came and said we're going to, the momentum usually continues till something else happens. Usually what we've had in the past for our bubbles, the most recent bubbles, is some kind of like a fraud, or some kind of big corporate event, such as Enron, or we look at look at the banking in 2008 with um, the brokerage firms at the Lehman Brothers, for instance. What happened, um, basically, is that catalyst. So these things take time. They don't happen overnight, but usually it happens with the, again, people who were like very much momentum oriented. And then once they get scared, things really fall apart fast. So I hope this was helpful. This was just a little history lessons, a little maybe shot in the arm, just share with you that you want to be invested. And kind of been cleaning up my affairs, and basically kind of taking some of my chips off, and trying to get ready for the next year. But as I mentioned, I would at least have a little bit of insurance, just be on the cautious side. So that's just my fatherly and elderly thoughts in me after the 35 years. So with that in mind, I want to thank you. We can stop, and then I open for questions and comments. Thank you so much.